Now let's switch to the investing landscape and what we are hearing in the monthly Bank of America Fund Manager Survey. There are a couple things that really stand out. One of them is how these fund managers are positioning here, because we are seeing unusually high cash positioning. Now, just a reminder to our viewers, when we say cash, we don't mean actual dollars necessarily. It's usually cash and short-term equivalents, so short-term debt, for example. But it's where fund managers tend to go when they are feeling nervous. And cash positioning is now at 5.1% in this survey. You can see it hasn't been at that level in quite some time. In fact, since May of 2020. So what does that mean? Well, according to Bank of America, it triggers what they call their FMS, Fund Managers Survey, cash rule. It's a buy signal, in other words, sort of a contrarian signal that people are getting more concerned here. So that's interesting, Soz. And I know for you, not only did that catch your eye, but also catching your eye was how positioning is changing more broadly and why it's changing.
Yeah, and you're also seeing outside of that rotation to cash, Julie, you're seeing investors rotate, an institutional investor, I should say, rotate into defensive areas in the market. Healthcare, also, according to this survey, REITs or real estate investment trusts, which I'm surprised to see that rotation into, given these are normally interest rate sensitive stocks. And obviously, of course, next year we might be getting several rate hikes from the Federal Reserve. But I will note this, too. There's a flip side to this coin. And if we do get a dovish Fed statement, Fed policy meeting later this week, BofA pointing out this, you could see a pretty strong rally in cryptocurrencies, unprofitable tech companies, banks, and emerging markets here. So for right now, it looks like the market is positioned defensively into Fed Day. We saw that in the markets yesterday, seeing a little bit of that carry over in today, but that could turn on a dime with one word out of Jerome Powell.
Yeah, and that then speaks to what these fund managers see as the biggest tail risk right now. And it is indeed central banks and the policy that we could see. And as we've been hearing in recent days, Brian, the potential for a policy mistake, I think, is really top of mind for investors here. What would a policy mistake look like? Well, that depends on who you talk to. Will central banks be too late and too dovish to attack inflation? Will they be too aggressive and overdo it and choke off economic growth? It depends on who you ask. This particular survey finds that hawkish central bank rate hikes are a risk to the market here, whatever they mean to the underlying economy, that because we have seen so much liquidity in the market, once we see a rate start to go higher, that could put an end to, or at least mute the party that we've been seeing. But at the same time, Saz, number two here is inflation. So if inflation is a risk, and the Fed has to raise rates in order to deal with inflation, then, it's sort of a lose-lose situation, I guess.
Asset bubbles, also a risk, number 4 on that list. But what is not a risk, and which is good, and, I'm in a great mood today, so I'm going to stay on the positive sides of this survey out of BofA. Recession remains a contrarian call. So good to see investors not positioning for some form of recession. A lot of folks that I talk to on the street saying a recession is not probable until late in 2023, if at all, in large part because of those rate hikes, which will start to accumulate later next year and into 2023. So no recession risk. That's pretty cool.
Wait, who is this? You're not gonna, warn us about some dire consequence?
I'm looking at the brighter side of the coin today. More in line with my historical nature, Julie.
I like this. Yep. And then finally, here's another chart that stood out to us: the rate hike expectations that are being priced in at this point in time. And as you can see, the expectations have really ratcheted up here. The purple line there is where they are now versus where they were just a month ago. And so now we are seeing consensus at 2 rate increases in 2022, although 1 is still up in the running, it's fallen back, and 3 has gone higher. So whatever way you slice it, it's definitely consensus at this point that we are going to get, let's call it 1 to 3, between 1 and 3 rate increases in 2022. So that is where these concerns are coming from, that are being reflected in that list of tail risks there, Saz.
Yeah, bullish CDs. Got to go to those my local savings and loan bank and start whipping up those CDs ahead of those interest rate hikes, Julie. Very excited about that.
Well, I mean, that's kind of what the fund managers are doing too. If they're going into cash, right? That's effectively what they're doing. But again, as the Bank of America survey finds, or as their rule finds, if all these folks are in cash, maybe that is a contrarian signal.